Welcome back to The Explainer. Today, we're putting on our investment analyst hats to unpack Interparfums, ticker symbol IPAR. This company is a truly fascinating case study in how to navigate a massive $70 billion global fragrance market. And you know what's most intriguing? They don't do it by outspending the industry giants, but rather by outmaneuvering them. They act as this hidden engine behind some of the world's most recognizable luxury scents, establishing a completely unique economic moat in the process.
Now, a 5.2% market share. I know, it might sound kind of small at first glance. But in the highly fragmented, intensely competitive prestige fragrance market, that specific slice makes Interparfums the fourth largest global player. There's no way around it. They are commanding elite shelf space and sitting right on the heels of massive established conglomerates like L'Oréal Luxe, Estée Lauder, and Coty. It's a real testament to their operational efficiency.
So here's our roadmap for today. We're going to look inside Interparfums' fragrance empire, check out their Q1 2026 financial snapshot, see exactly how they're competing with the giants, navigate some global market headwinds, and finally, map out their path to 2027.
Let's kick things off with Section 1, Inside Interparfums' Fragrance Empire.
When you're evaluating a company's revenue streams, geography is absolutely key to understanding their structural advantages. Out of their $1.49 billion in trailing 12-month revenue, a massive 75% flows directly through their European operations, which are anchored right in Paris. The remaining 25% is driven by their United States and Italy-based operations. From an investment perspective, this deep entrenchment in the European luxury ecosystem provides a significant reputational moat. It essentially places them at the geographical epicenter of the prestige fragrance world.
So how do they actually operate? Well, rather than building untested brands from scratch, management executes a highly efficient, high-margin, three-step business model. It's honestly a brilliant example of a capital-light strategy. First, they secure exclusive long-term licenses with elite fashion houses. We're talking Montblanc, Coach, and Guess. Next, they leverage their specialized expertise to develop and manufacture the actual fragrances. And finally, they distribute these products globally across more than 120 countries. Essentially, they're borrowing the massive brand equity of existing luxury giants to generate their own highly consistent cash flows.
Moving right along to Section 2, the Q1 2026 financial snapshot.
As the broader market normalizes from that wild post-pandemic boom, we're specifically looking for resilient earnings and strong management execution. And Interparfums delivered exactly that in Q1 2026. Net sales reached $345 million, representing a solid 2% year-over-year increase. But the real story for us as analysts is their operational discipline. Gross margins expanded to a highly impressive 65.1%. That's a 140 basis point jump year-over-year, driven heavily by a favorable brand mix and lower inventory destruction costs. Ultimately, that operational efficiency pushed their earnings per share up by 2% to $1.35.
Now, right behind those top-line figures is the sheer power of their core franchises. The legacy brands are really doing the heavy lifting here, with Roberto Cavalli surging a remarkable 32% and Coach jumping 30%. Even their massive, established pillars like Montblanc posted strong double-digit gains of 14%. When management notes that their top 20 brand region combinations represent 86% of total sales, it proves that their core portfolio is incredibly sticky with consumers. They aren't just relying on one-hit wonders. They've established a highly durable portfolio of high-performing assets.
Because of this consistent profitability and structural efficiency, Wall Street is currently assigning IPAR a pretty noticeable valuation premium. They're trading at a forward 12-month price-to-earnings ratio of 18.93, compared to the broader industry average of just 13.73. Look, in the eyes of the market, you generally get what you pay for. Investors are clearly willing to pay a premium multiple for a stalwart that consistently defends its margins and demonstrates superior capital allocation.
Which brings us to Section 3, Competing with the Giants.
You might be wondering, how exactly does a smaller player successfully battle absolute titans like Conti or L'Oréal? Well, by purposefully not playing their game. While competitors rely on massive scale, massive own brand portfolios, and inevitably deal with heavy corporate bureaucracy, Interparfums operates with an agile, decentralized structure. They give their individual brand teams high levels of autonomy. This agility results in much faster product development, rapid responses to market trends, and an incredible operating margin of 21.5% that vastly outperforms the roughly 15% margins we typically see from their larger, heavier competitors.
What we're evaluating here is a classic economic moat. The absolute crown jewel of their competitive advantage, it's their ability to maintain 30-plus-year relationships with brand owners. That level of institutional trust is incredibly rare in the volatile licensing world.
and it acts as a massive barrier to entry for any competitors. Add to this their agile operational structure, superior financial discipline, and an upgraded BBB rating from MSCI, which shows strong mitigation of environmental risks, and you have a structurally sound enterprise built for long-term compounding.
And that robust operational moat directly translates into strong analyst confidence. Right now, 6 analysts polled give the stock a strong buy consensus rating, projecting an average price target of $109.33. That target suggests the market sees significant upside potential and fundamentally trusts management's long-term strategic vision, even acknowledging that there may be some macro bumps in the road ahead.
Let's shift gears to Section 4, Navigating Global Market Headwinds.
Of course, no global enterprise is completely immune to macro headwinds, right? Analyzing risk is absolutely crucial, and the current performance data reveals a sharply divided globe. In the Americas, brand strength is driving massive growth, highlighted by a 23% surge in South America and a steady 7% growth in North America. However, the Eastern Hemisphere tells a very different story. They're experiencing real declines in Eastern Europe due to specific operational difficulties with brands like Lanvin and Lacoste. Furthermore, they're seeing severe volume drops in the Middle East, driven directly by ongoing regional wars and conflicts, affecting both distribution and consumer demand.
Facing those geopolitical uncertainties, management is issuing some highly conservative initial guidance for the full year of 2026. They're projecting revenues to bump up slightly by 1% to $1.48 billion, but they are forecasting diluted earnings per share to actually drop 5% to $4.85. As analysts, when we see a forecasted EPS contraction, we have to ask the critical question: is the underlying business deteriorating, or are they simply absorbing temporary external shocks while reinvesting for the future?
So, why the drop? Well, in this particular case, the earnings pressure appears to be driven by strategic transition and macro absorption, not fundamental deterioration. The 2026 EPS contraction is really a mix of several factors. First, they're absorbing the expiration of the Boucheron license. Second, they're navigating the impact of global tariffs. Third, retailers are still cautiously destocking existing inventory. And finally, they're missing the absence of one-time tax gains they enjoyed back in 2025. But most importantly, they are purposefully incurring heavy upfront investments right now to fund the massive brand launches they have planned for next year. It's a classic example of exceptional capital allocation, taking a calculated short-term hit to earnings for long-term market positioning.
This leads us perfectly into Section 5, the path to 2027. CEO Jean Madar stated it pretty clearly. He said, "In 2026, we will focus on consolidation. We expect 2027 to be a very strong year as we ramp up the distribution of our newest brands." From an investment perspective, it is incredibly refreshing to see leadership communicate this transparently. They're openly telling the market they're willing to sacrifice a few pennies of near-term earnings today to properly fund the advertising, logistics, and infrastructure required for their next major wave of brand rollouts tomorrow. When we map out their launch pipeline, this long-term strategy really comes into full focus. 2025 saw the conclusion of the Boucheron license. 2026 serves as the strategic bridge year, focusing on maintaining consumer engagement through line extensions for Coach and Lacoste alongside the Solferino rollout. But 2027, that's when the floodgates truly open. That is when they're scheduled to debut blockbuster launches for Montblanc and Guess, alongside highly anticipated new brand debuts for Off-White and Longchamp.
Which leaves us with the ultimate question. With a highly disciplined operational moat and a massive pipeline of blockbuster launches set for 2027, is Interparfums' momentum literally just getting started? When you combine an agile, decentralized team with industry-leading margins and a proven track record of successfully scaling luxury licenses, this brief period of consolidation might just be the exact launching pad for their next massive run. Thanks so much for joining this explainer, and definitely keep a close eye on IPAR's next moves.